Thank you so much, Wayne. I found your presentation really exciting from an opportunity perspective, but also really scary just from a pressure perspective on cities. If I have to think about calling an Uber this afternoon in Strand's gridlock traffic, it might just arrive in January if I'm lucky. I now want to follow up with a panel discussion. Simon Goveloos, Head of Real Estate Finance, South and Central Africa, Standard Bank. Thank you.
Thank you. Good morning, everybody. Today we'll be talking about crowding in capital in Africa. I've got a large panel, so if I can welcome my panelists up and we can get to it. I've got Nema Bird from the DFC, is the Managing Director. Kamogelo Mawaneng, the CEO of Letlola Lerona in Botswana. Olumide Oyotan, the CEO of Stanbic IBTC Pensions. Saurav Chatterjee, the CEO of Care Ratings in Africa. And then Ken Osei, Principal Investment Officer at the IFC. Thank you.
I'm fine, how are you?
All right, I think we've had a similar panel in a sense over the last 2 years at API around DFIs specifically. I think today we'll focus a bit more on local pension funds and how we can mobilize that local capital. So maybe Nema, let's start with yourself. In terms of promoting financing structures that bring in local participation, how can DFIs help promote this? What structures can you look at to better integrate banks, pension funds, and the like in the local markets to try and move away from this foreign kind of focus we've seen historically?
Yeah, thanks. Thanks, Simon. And good to be here again and speaking about crowding in capital. So certainly representing the U.S. International Development Finance Corporation, DFIs, are mandated to crowd in the private sector financing opportunities. So at the outset, we structure loans and investments with the mindset that we want to bring in the local capital providers, so the local banks, pension funds, insurance companies, et cetera. And so we can use several tools in structuring. One of these would be co-lending and syndications. And so we take on, DFC would take on a senior lender position, or we could be pari passu with other lenders. But the goal is to de-risk the investment and provide that sense of stability for the other lenders to come in. So risk-sharing experience for the local lenders. Another tool that we use would be our guarantees. So our funding is dollar-denominated. However, we do have borrowers that would require a local currency. And so we provide credit guarantees to a local bank so that they can extend credit to a borrower or a project that otherwise would be deemed too risky. So DFC's credit guarantees will go up to 80% of the principal of the loan, and we will take a first loss position. So that provides some level of comfort to the banks to actually proceed, and also to bondholders in the event of credit guarantees on bonds. We also create local investment vehicles. So you may have heard of the U.S.-Ukrainian Reconstruction Investment Fund that was launched recently, $150 million for the reconstruction of the country and long-term economic recovery. And so DFC is providing a 50% commitment to that fund, so $75 million, and then the local Ukrainian government is providing the balance. We've also structured exit pathways for our investments so that our loans or our investments are paid down over a period of time and refinanced by local investors or local banks. So we come in and basically de-risk the project. So think, for instance, in construction projects, we're coming in with that first capital for the construction, and then once the building property is stabilized, we can be refinanced out. and we've basically underwritten the riskiest part of that investment. Another way that we can crowd in local capital is by providing funding for feasibility studies. And so we have a group that looks at providing project development funding. And so we would take on or provide capital, and many times this is actually grant funding that's not required to be repaid. And this goes in to carry out feasibility studies, to de-risk projects, and basically anchor the bankability of those projects. At the end of the day, we come in with these structures that promote and encourage local lenders and investors to take on or invest in particular projects. But at the end of the day, the structuring is not the only thing that we do. I think just working alongside the local banks helps them to develop their underwriting skills. There's also a lot of transfer of knowledge and learning, even through using experts in the field, legal experts, and other experts such as independent engineers, et cetera. And at the end of the day, these projects create a demonstration effect so that others can look at this and look at the successes, and it kind of demystifies investments in these sectors, whether it's project financing, infrastructure projects, or real estate projects.
Cool. Thanks, Tim. That's quite extensive. Can maybe coming to you from the IFC side and also, fellow DFI, anything specific that you look at from the IFC set, products, the like, support maybe for tapping in for pension funds specifically and raising or mobilizing that equity?
So from an IFC perspective, I mean, we do equity investments directly as well as through venture capital funds, and then we're an LP in private equity funds, right? So on the equity side, which is I think increasingly the biggest gap in the property industry, is we're able to do equity, but we're restricted to a maximum of 20% of the equity typically. So where does the rest come from? And this is where pension funds are quite critical. So the IFC, I mean, we've invested, say, if you take South Africa, for example, pension fund investors that we've invested alongside include EPPF, the PIC, Namibia's government institution pension fund. And I think crowding private capital, both pension fund as well as long-dated capital, because very often in the property sector, you need a few years where you're not going to get any rentals, you're not going to get any yields, you're not going to get any returns. So you really need that upfront equity capital. We're able to do that sparingly, right? Now, I say sparingly because when you have a US dollar balance sheet, right, investing in a continent where most of your rental income is going to be in local currency, even when it's pegged to the US dollar, your tenant is actually paying you in local currency. So there's a bit of a mismatch between the currency in which your balance sheet is and the receipts in which you're getting. So your return expectations are then impacted. So getting in local pension funds who have a longer horizon, we think is quite critical.
All right, thanks. Sarah, if we come across to your side, so, I mean, we've just heard, DFIs anchor a number of transactions, they unlock a lot of these projects. Can DFI support go further? Are they able to try link anchors to transparency standards? And I guess in your world, then, public ratings, ESG reporting, covenants, how do you see that kind of playing or coming to the fore to help give more comfort to even pension funds or other investors to crowd in that capital?
Thank you, Simon. And I'd like to thank API for inviting us to this conference. I think I heard IFC and DFC. I think, DFIs actually set the tone for the market development. By anchoring early deals, they not only de-risk the transactions, but they also send strong signals to the market for broader investor community. But then their support should come up in terms of conditions, that there has to be public ratings, there has to be monitoring, and there has to be performance. I heard IFC, and I heard that, right, primarily in Africa today, most of the funding is happening in dollar. But then there is always the risk of dollar getting the local currency depreciating, and the property is losing out on in terms of the loan getting devalued because of that. And as rightly stated, that the earnings are in local currency. I think that's where, when the DFIs come in, they give the initial support they have the property, the construction risk is taken care of, and once the property is up and running, then that's where the local pension funds, the insurance companies, the asset managers should come in, and that should come in the form of a local currency bond market. In across Africa, when I look at, I think probably South Africa and Nigeria are where we have two local currency bond market. And over the last few years, we have seen the local currency bond market coming up substantially in Mauritius. There are insurance companies, pension funds who are investing. We have seen companies like ENL, and I have my friend Nicola here, who is from Lavastone, who have gone and done local currency borrowing and who have used as funding. So essentially, it's the role for the DFIs to support. We have seen in Nigeria a couple of years back this infra credit, which was backed by a guarantor credit, which was tied with the transparent structure to bring in local pension funds, and who were previously hesitant. Even in Mauritius also, when we came in, we saw the pension funds and the insurance companies are not very much interested to take exposure in the sector. But then over the period, we have seen they have come in. I think that's where rating has played a very critical role. And the transparency, and when we see ratings, we don't say some alphabets. We say that we have come up with a rating rationale. We put it in a perspective. We have, as you said, we have some ESG reporting, and all this actually gives confidence to the investor. So if the DFI first puts in the money, the assets get developed, and that's where the insurance companies or the pension fund comes in, then the DFI can actually use that particular money to put in some other development of other projects. So that's where that can kick in. We have seen company in the last couple of years, I have seen Fond Solidarity Africa, FSA. We have seen Damana, and I think you mentioned also some companies, guarantee companies has been set up. So even in my company, in my country, India, we have seen that these blended financing facilities have worked best. When concessionality is time-bound, ensuring that the market don't depend on, it doesn't become dependent on DFIs, but instead it can be scaled upon. So to sum up, I could say that DFIs systematically paired their early anchoring role with time-bound concessionality and transparency conditions that they could establish. And the same model can be replicated, a template can be created, and the same model can be replicated by the local pensions, insurers, and the broad investors. So typically, my view or our view is 18 to 24 months, the DFI should stay back, the local capital steps in, leaving behind not only stronger institutions. Does that mean I am saying that DFI should stay back 100%? No, they can stay put for 40, 50%, but then give chance, the local currency comes in, and there has to be an effort to develop local currency bond market across Africa in different regions. Only when the local currency comes in and the funds get utilized in that, that's where we can see the real growth. I'd like to finish this with one example. In Kenya, if you look at most of the banks, the credit to deposit ratio is 50%, which means that they are actually putting the money in treasury bonds or US bonds. So basically, we are putting our money in US bonds, but not using it for development of infrastructure. And I saw Wen coming up with those slides where he say that this is the next 25 years, we are going to see infrastructure growth in Africa. So why not use the local currency to fund the growth and utilize that and get the benefit? Thank you. I hope I have been able to.
No, good. Thanks, Sarah. I think you touched on a piece around REITs, more kind of transparent investment structures and the like. So I mean, the kind of segues a bit into almost a regulatory guideline framework and comfort for pension funds and other investors to come into. So maybe coming to your side, obviously LLR is based in Botswana, often praised and hailed as one of the most stable countries, challenging 2025. So let's park that piece temporarily. But so I guess from your perspective, how does Botswana's investment climate give confidence to international and both domestic players? And what lessons could be learned from Botswana in terms of that governance, regulatory environment, and attracting instos and capital into real estate?
All right. Thank you very much, Simon, and good morning, everyone. So from my perspective, right, the lesson from Botswana is very simple. Strong institutions, strong countries like ours attract strong capital. So you already mentioned the first part in the sense that Botswana is very stable by its very nature. It has a very long history of sound fiscal management, democratic governance, which the world witnessed last year, October, when there was peaceful change from the ruling party, which had been ruling for about 58 years. And the new government, it was handed over very peacefully. So that strengthens investor confidence in us. Over and above that, there's huge respect for the law in Botswana. So the regulatory environment is very strong. So all these speak to political stability, currency stability, and just safety in terms of the investment climate there. You know, from a regulatory environment perspective, you know, we operate within the BSE, Botswana Stock Exchange. It follows best practice. It's very well aligned with international standards. And again, that gives investors confidence that once they put their money in there, they're safe. So cash, I'm thinking cash is king, right? And kings live in castles, kings are guarded. They even have bunkers just in case of whatever unfortunate event. And those are really the structures that Botswana puts in place in terms of ensuring that pensioners' money from DFIs and pension funds is quite secure. So over and above the regulatory environment, from a real estate perspective now, land rights, land property ownership and title is very solid and is highly enforceable. So nobody will come to Botswana, and if you invest in real estate, nobody tomorrow will take away your land. So really the property rights are what they are really worth on paper. So that gives stability really and security to shareholders and other investors. So what other African markets can learn? I think it's transparency. I think Wayne covered it quite well. Or was it Khan covered it quite well in terms of the transparency index. As much as South Africa is fairly high up there from an African perspective, Botswana is also making its way up the ranks in terms of transparency because people want information, right? Investors who are not based in the country would want to understand the type of market they're investing in. So it's important that as Africa, we disseminate information to the market to give them that confidence. So really, in a nutshell, it's those three things from a regulatory environment, political stability. And talking about regulatory environment, I think it was last week, there was actually a headline in one of the newspapers insinuating that we're over-regulated. It said, America innovates, China imitates, Botswana and Europe regulate. So that's really the strength of our regulatory environment, which should give my fellow panelists here confidence in coming to Botswana to invest. We are, similar to Lango, in the process of raising capital right now. And we've had quite a lot of interest from both domestic and international pension funds looking to come into Botswana because our story, I mean, is untold, right? But we are a growing country, we are a stable country, and we're investor ready.
Can I add to that a little bit?
Yes, please.
I think what you haven't mentioned to the people is that I think out of the two countries which has an investment grade rating in Africa, Botswana is BBB or BBB plus rated. In fact, we have a global rating agency which grades Botswana at BBB plus, and Mauritius as BBB. So I think Botswana is the highest rated investment grade country in Africa.
Thank you very much.
So I think that should give a lot of confidence to the investors.
Absolutely. Thank you very much for that.
Thanks, guys. So I have a nice little addition there. So come on, just following on your piece there, just what is your message to the pension funds and why specifically real estate in Botswana and in Africa?
Yeah. So what we do at LLR and generally in the real estate sector is that we match the different types of funding. So when we talk about pension funds and why real estate, you know, with pension fund, it all starts with their asset and liability matching model, right? So their pensioners, they're investing for the long term, which is very well aligned with real estate investments. They're trying to strengthen the operating environment in which their pensioners depend on, right? So by pension funds and DFIs investing in real estate, it really it spurs economic growth, right? It spurs economic growth. It enhances job creation. So there are a lot of benefits, and as well as being able to effectively give returns to the pension funds. They have obligations. I mean, when you reach a certain retirement age, they need to give pensioners that consistent income. And at LLR, that's something that we do very well. Over the years, we've been able to give our shareholders consistent distribution over the years such that no pensioner goes hungry.
Yeah, I guess real estate being inflationary protection is a
That's it.
key long-term investment for pension funds. Olumide, maybe good times to come to you. We've heard a lot around DFIs, unlocking debt, different bonds, but ultimately, how do we get local equity coming into the play? So I guess specifically, while we're on the regulation kind of theme, what changes or things do you think need to happen in order to improve? Is it allocations to real estate? Is it just interest? Is it education? What kind of do you see from a pension fund perspective to unlock that capital pool?
Thank you, and good morning, everyone. I noticed that I have to be careful as the only pension fund manager on the panel. But the good news is that, sitting and operating in Nigeria as a pension fund, we are desirous of increasing allocation to real estate assets. I think the challenge is properly structured instruments that permit us to actually invest. And in certain cases, as well as mentioned by my colleague here, Suraj, we want to ensure that, we don't take developmental risk. I think pension funds shouldn't be, at the forefront of risks. And if we must take those risks, then there should be sufficient compensation for those developmental phase when you are going to forgo some sort of returns. And how that is structured is very important. The way we operate is that we have a set of investment guidelines by our regulators that permit us, we can invest in real estate investment trust. We've not seen, we don't have that many in the local market. We can also invest via private equity funds as well. And we've seen some real estate focused private equity funds, and we have indeed actually allocated some capital and made some commitment, and in some cases even done some co-investments as well. We don't see enough as the challenge based on the institutional pool of domestic capital. What we also see are developers, that have certain attractive pool of assets and trying to sort of recycle their funding out so that they can go and do what they do best, which is to develop other real estates. And I think if we can find those right structures for, asset class, income generating, attractive in certain local, whether it's residential, whether it's commercial, or even industrial, just ensuring that that thing stands up to regulatory scrutiny. Also, I have to be careful what I say because my regulators are also in the room. But, the good news is also that there's a meeting of minds, and we're quite progressive in the way we are trying to look at alternatives, of which real estate is a crucial part. And because we also have experienced high macroeconomic volatility, which, based on the presentation, we see stabilizing, we see currency risk, high inflation. We think asset classes like real estate, actually, mitigates and gives us the diversification benefits that, we are looking for. We've seen certain categories in the local market, perform extremely well, whereby, grade A buildings that have high quality tenants, dollar-linked rentals, and, their capacity to even withstand the local shock is quite high. and we do see ourselves, looking to participate in more of those types of things. I think we still need to see more higher quality developmental assets and grade A types of assets that are pooled in the right structure that will permit us. But I think the first thing that, we just have to be clear is that we have to balance our fiduciary responsibility towards ensuring that, capital is returned whenever we deploy, and that we do get something that is competitive that would ensure that, our members or our retirees retire well. Yeah.
Thank you for that. Ken, I'm going to come back to yourself. We're talking around offtake mainly once the project's done. But again, how do we get these projects off the ground? I mean, we've been doing this for years, but oftentimes your promoters are smaller, don't have the big balance sheets, they lack the capital, the local capital, and then to a point earlier, you've got cash flows in local currency, but other investors want dollars. How do funders better coordinate and aggregate then in these different pools to get local capital to support these projects?
I think that's a huge issue, Simon and colleagues, is that, as much as each of us sort of entrepreneurially want to go and develop our own shopping center, office building, property is an expensive undertaking, right? And especially where you're dealing with inputs, which are, cement, steel, and sometimes they're imported, so they're subject to sort of global uncertainties in terms of pricing. So I think as property developers start out, it's important to first assemble and aggregate a pool of capital that is appropriate for the development phase. The development phase basically requires a long runway, has some uncertainty, and will generate no short-term cash flows. One category of capital that we often don't look to is insurance. So life insurance companies basically receive receipts from providers of insurance premiums, and they are able to hold that for a very long period of time. So in addition to pension funds, or as an alternative, is maybe we need to be looking more at insurance companies. You'll see here in South Africa, for instance, some of the big property developers, Ares Property, for example, is owned by Momentum, right? So that's an interesting example of where, by partnering the right type of capital with the development phase, we can de-risk it. The other issue is aggregation. So we have all this capital sitting around, but it doesn't come together. And that's something that I think as we, folks look to go and develop properties, is maybe spend the time aggregating the different pools of capital. So in the early stages of development, it needs a patient capital that does not look for an immediate return. So things like insurance. Sorry to pick on my pension fund colleagues again. It's also local by definition, and it's by definition patient. So pooling those types of capital together. Very often, the other extreme is going to more private equity, like, which has a very short shelf life, right? And property is a long-dated asset class. So you need capital that's long-dated in the development stage, and then also the aggregation. I'm probably not doing myself a lot of favors by saying, well, DFIs are not the best suited. DFIs do the de-risking by signaling, but DFI capital also has a cost of capital. So even though it's long-term, and because it's, very often DFIs are linked to sort of hard currencies, that could become a problem. Thank you.
Olamide, back to yourself quickly. So, you touched on limited development risk. If we've got limited pools, the insurance element's certainly a nice one to come through. And yes, pension funds may be longer term. How do pension funds take more dev risk, and in what form? Is it a manner of portfolio, allocation one to real estate generally? So you've got larger pools, and then you can invest a smaller piece, or the other ways that you'd think how to do that?
So I think it depends on a variety of factors coming together. The credibility and the experience and track record of whoever's involved in developing the assets also then matters. And then also, what are the mitigants that we'll put in place to ensure, successful execution, and that the project, does not become stillborn. And then even if it were successfully executed, what are the upside that you will get as, you know, a pension fund? Now, I mean, within our own local pool, we do have different categories of funds. So maybe for the higher risk funds, for the younger generation people, we could look at potentially looking at those types of structure. It's not our preferred, just because, as I said, we would like stabilized assets. We have local currency funding. We don't mind local currency. So long the returns gives us inflation plus, then, you know, it's something that we can sort of track the escalations over the lifetime of that particular asset, then we should be comfortable. But those things must fall into place. You know, the track record of the sponsor, the ability to execute, the capacity, the ratings, and all those things. So there are quite a lot of hoops that you will have to jump through if you were to look at pension funds, you know, coming at the forefront of taking developmental risk. It's not impossible, but it's a bit more difficult than stabilized assets, just because we don't do the sexy stuff, generally speaking, as a pension fund. Yeah.
Great, thanks. A bit more open, and I look at experience in Botswana. There's a couple of large pension funds, but they then give allocations to mandates to asset managers. You spoke around a return that's inflationary plus, but yet we see a lot of asset managers allocate capital on a very short-term basis. They focus on yield for the 3 to next 6 months for their annual returns and their annual bonuses. How do we change that narrative to look at a total return that now gives you obviously inflationary plus returns over the long term? I don't know, it's open to the panel. Come on, maybe if you've got experience, obviously I've referenced Botswana, but otherwise happy to hear other thoughts.
Yeah, Simon, that's a very good point. And that's a drive that we're on currently to educate asset managers, because rightfully so, remember, asset managers are investing on behalf of pension funds. And we spoke earlier about pension fund money being patient money for long-term investments. So you shouldn't look at it at a point in time, which is exactly what yields do, but over the returns over a long period of time. And also when we talk returns, what are we actually talking about? Yield is just, you know, the net income yield at that point in time, but we're completely ignoring the capital appreciation aspect of it. So one of the things that we've tried to engage with our shareholders on and continue to engage with them on is that they must look at it at a total return basis. Because if I put $100 in an investment, I want to know that in 10 years' time when I exit, I'm gonna get $200, as well as the cash flows in between, right? So there needs to be an alignment between the pension funds as well as the asset managers to streamline the requirement and the mandate of the pension fund to take a longer term view for asset managers. I mean, right now in Botswana, as you know, we're going through a bit of a liquidity challenge because the diamond sales have been dwindling quite a bit, right? So what we're experiencing is that the interest rates are extremely high. I mean, in the past few months, they've gone from maybe like 9% to even 18%. So they've practically doubled. So making it difficult for companies like us, where we all know that real estate returns are relatively low because low risk, low return, right? So we've had to engage extensively with asset managers where they're looking at it and saying, but why, if we're getting 18% in a money market, should we not park it in the money market? Why should we now settle for 9% or 10% return or 12% total return? So we need to then engage and say you need to take a long-term view. The 9% is on the yield, and then over time, your capital appreciation will be over 200%. We're actually releasing our financial results next week, where we will unpack exactly what we mean when we say total return, yield, and how the investment has performed over the past 5 to 10 years. And that's really the focus that people should be looking at, especially those managing on behalf of pension funds.
Great, thanks. I see we're running fast out of time. we've heard quite a bit about green climate financing and the like this morning. We've obviously spoken a lot about this in the last few years on our panels, and it's been a key focus. Just a curious question, I guess, in the sense of we're seeing a lot of the first world kind of markets and economies not necessarily pulling back from green, but labeling it differently given some of the challenges around that. And we heard resilience coming up this morning. Is ESG still a key cornerstone in the decision matrix for, I'm going to start DFIs primarily, in terms of how you assess your projects and transactions? Or was it just that embedded that it's kind of done that we don't have to talk about it much? It's business as usual, which is, I think, where we're all moving, but just trying to get a sense from your side.
If you ask me how much Africa contributes to the global emission, less than 4%. But then there is always a diktat from the Western world that we are giving you fund and we have to shape up yourself to do ESG. But having said that, I think whatever we talk about ESG and all, it is very important that we should be linking it to various KPIs of the sustainability, whether it's while we focus more on environment, but we should not lose our track on the sustainability and the governance part. It's very important to see that how there are these affordable housing homes which are getting created for the students. For one example, I'm just taking one example to give that if these homes are getting created for the students and these are financed by ESG money and these are ticking the KPI, UNDG boxes, I think we should get this money, but we should also ensure that there is a proper sustainability linked bonds as per the ICMA guidelines which are getting issued. We recently in Mauritius, one of the big groups, conglomerate, has issued a sustainability linked bond where they are getting benefits in terms of the lower interest rate, but they have committed that over the next 2 or 3 years, they are going to meet certain KPI requirements, and they have set those targets. So it's very important. It's not that we have to follow the Western world. We can set our own targets, communicate to the investors. It can be pension funds, it can be DFIs, it can be, but then somebody needs to monitor whether those KPIs are being met. If not met, then they should be, has to penalize for that. But if you ask me, ESG is important, yes, even if we are not contributing to the world emission, but we should be looking into sustainability development, and those can be green buildings, those can be green housing, this thing. So that's my view.
Thanks, Nimal. Okay, either way, I know we've touched on social housing, for example, as opposed to just green, but maybe it's all your thunder.
So, I mean, in terms of ESG, we still have, as a DFI, we still have certain thresholds that we need to meet from an environmental, social, and governance standpoint. And I just want to touch base on that social aspect of things. There's no real getting around it. There's significant risk to ignoring the social well-being of the people that are either going to be impacted by the project or are going to benefit from that project. And so when it comes to things like greenfield developments where people have to be relocated, ensuring that that is done in a proper manner, whether it's also respecting historical sites, etc. Governance, as we all know, has been shown to contribute towards the profitability of companies, and we certainly want to have or ensure that our borrowers meet the thresholds that we require from a governance perspective. So, in viewing ESG from a risk mitigation standpoint, it's still very much forefront.
Okay, thanks. Kenya, if anything to add, then...
Yeah, I think, if we move away from sort of just the tagging of ESG, right, which sort of sounds like labeling, right? The built environment, the IFC did a study 2 years ago about, building green and found that something like 40% of greenhouse emissions come from the built environment. And that comes from the use of steel, cement, which are very high carbon intensive. But then there's also the aspect of buildings need HVAC systems, water, cooling, heating. So the aspect of the E is actually a cost and a benefit to build this. So building green is not just to sort of tag it, but it actually delivers some benefit to the owners of the development. So if the financing instruments, green bonds, sustainable bonds, etc., are simply a way of specifically earmarking funds to building green. I think similarly on the social side, right? So it's around impacting communities, etc. So these are instruments where use of proceeds bonds have been developed specifically for that. So a number of our clients, I mean, we worked with the likes of Redefine, Growth Point, a few other companies also looking to do this more and more. I mean, in Egypt, for example, we've done something with ODE in the tourism hospitality industry, where you actually earmark your funding to support the development of green and social properties.
No, great, thanks. I think we have to park it there. Please reach out to any of us during tea and networking for anything further. And yeah, thanks for your time.